Hello and welcome to Middlesex Partnership Compliance Matters. I'm Robert Johnson, and today very lucky to be joined by an award-winning compliance expert and senior advisor with Co-CGIC, John Burns. Welcome, John.
Thanks, Rob. Pleased to be here.
John's been instrumental in the development of UK payments regulation, and we'll be talking about PSD today. So, John, you were involved in payments regulation when it was first introduced in the UK. Can you give some background as to why it was needed and what was done?
Thanks, Rob. Yes. Way back before the introduction of PSD, payments regulation in the UK was basically self-regulation. And to give one of my favourite quotes from Willem Boyter, self-regulation is to regulation what self-importance is to importance. It's just not the same thing. But really the driver came from the EU. I well remember going to a conference at the Café Royal, and a lady called Sue Pereira from the European Commission was there, telling us about what was then called the new legal framework for payment services in the internal market. Snappy title. And I came back to Apex, where I was working at the time, waving this thing saying, have you seen this? This is going to be major change. And people kind of shook their heads and said, no, it's just a European Commission proposal. It'll never come to anything. It did. Basically, at EU level, the view was that the banks had payments tied up too tightly, and that in order to join in payments and to you had to get banking authorization, which is way over the top for the risks actually involved in payments. So one of the things they wanted to do was to open up the market so that other players could provide payment services on that. So I got involved in the negotiation of the directive from Apex and the Payments Council side in terms of negotiating from the industry side. And then when it was passed and had to be implemented in the UK, there then came a battle between the Bank of England, the OFT, and the FSA, as it then was, as to who was going to be the regulator. And the battle was that none of them wanted to be the regulator. They were each pointing at each other. And the FSA lost out and was given it, which I think was the sensible route for it. But basically, I then, when they were given it, because it'd been self-regulation up to that point, they didn't have anyone who really knew payments there. So I sent my CV in saying, essentially, you want someone who knows about payments then. And luckily it did. Interestingly, one of my interview questions there was, do you think they should be implemented through FSMA and a handbook or as a separate regulation? And I said separate regulation because I didn't think it fitted with the handbook at that point. But as we might come on to later, the direction of travel in the FSA at the moment, and the FCA at the moment, seems to be to move things towards FSMA style regulation of it. So watch this space as to what's happening there.
Okay, so would you say that PSD 1 and 2 have been a success? And what's made it work and what hasn't worked?
I think largely it has been a success. I think one of the major things that PSD 1 caused to happen was faster payments and the take-up of faster payments. Because if you remember back to PSD 1, it required that payments were made within D+1. In other words, when a payment instruction was given, the funds had to be with the payee's payment service provider by the end of the business day following. And if you remember back to those days before faster payments, everything, unless it was going by chaps, which would have cost you even then £25 a payment, or by cash for same-day value, had to be, it took at least 3 business days to do it, because it was going through the bank system. So the industry, and this was at Apex, the Payments Council I was working at the time, had the choice of either speeding up backs or implementing to a greater extent the faster payment system, which they were already looking to bring in at that point. And the decision was made to go with faster payments. on the basis that BACS then became a same-day payment system, because debits and credits on BACS happen on the same day, but with a 3-day lead time. In other words, you've got to give a forward-dated payment instruction in BACS, but we've got a system that does it immediately. As an aside, one of the things that has always amazed me is the just quick acceptance by the public of a change from taking 3 days to do a payment to taking 15 seconds to do a payment. Because basically the UK public just shrugged their shoulders and said, oh, that's fine then, and went on with their business. As what didn't work, and one of the unintended consequences, I think, the fraud side, because fraudsters are always much sharper and quicker at seeing advantages on the in payments space. And they were much quicker to see that if you can get a payment done in 15 seconds and then move it on in 15 seconds and so on, they can shift the money much more quickly before anyone's had a chance to catch up. So I think that's a downside. That's one of the unintended consequences that we never saw. I never foresaw on that. I think in general terms, the conduct provisions of PSD have been a success. I think they have forced the banks and the car companies to do the right thing in a way they didn't before. I mean, before PSD and BCOBs, which was non-PSD transactions, there was a thing called the banking code, which looked wonderful when you read it. But the problem with it was all down to the banks to interpret what it meant when a customer was being negligent and so on that. And again, that self-regulation, the banks tended to say, well, basically it was your fault, customer, where you go on that. So customers lost out. It's given customers much more rights on that. PSD2, I think one of the big improvements on that is the third-party payment providers, the account information service providers and payment initiation service providers, which is still in the process of taking off. But I do think within a few years, anyone who's not doing that will be at a disadvantage because customers will come to expect it. I do think one of the advantages is also the improved security through strong customer authentication. People who get fed up with having to do strong customer authentication may disagree with me on that, but as I chaired one of the subgroups at the European Central Bank Forum for Security of Retail Payments, which came up with a definition of SCA, I've got to hold my hand up to it and say my fingerprints are all over that. But security, as we move remotely, moved into a much more virtual world, really becomes that much more important on that. So I think it's those have been the successes on that. I think one of the downsides, one of the things that hasn't worked, is the requirement for banks to provide safeguarding accounts for e-money institutions and payment institutions. It is a requirement which is, as they say, more honoured in the breach than the observance, because every bank's supposed to provide accounts on a proportionate, objective and non-discriminatory, or POND basis. They are not doing it. It's very difficult for a payment institution or e-money institution to get a safeguarding account. And the attempts to get the payment systems regulator, the FCA, to actually intervene and make the banks do what they're supposed to be doing have not really worked. So I think that could do with strengthening.
And I guess that has particular implication for the smaller organisations, smaller institutions.
Yeah, I mean, I think the reason banks won't do it, other than there not being much money in it for them, is they have concerns that they will be held responsible for some activity that a payment institution or money institution is clearing through them does. That they will somehow be held responsible for, say, terrorist financing or something like that. So their risk appetite has become really, really low on that. I think if the FCA was to make clear that they wouldn't hold a bank responsible for it beyond normal monitoring of the account. That would probably improve things and make the banks a little more willing to provide the accounts.
And how would you say the FCA's attitude to payment sector has changed, and why?
It has changed 180 degrees. When I was at the FSA, payment supervision was two people. It was Tim and Karen. And it wasn't even their full-time job. It was kind of off the side of their desks in supervision. We now have a department of more than 50 called Payments Markets Intervention. I think the title of the department in itself gives an indication of the way things are seen, which has managers, it's a head of department, managers, technical specialists, a whole team of people whose job it is to look after the payment sector. So 2 up to 50, that's a sign. Also, CACIGIC, or Compliance Services as it then was, we had an event in November last year where Nicholas Webb from the FCA Payments Markets Intervention team came across to give a keynote speech. And Nicholas said in his speech, not in a panel session, it wasn't off the cuff, this was approved by the FCA, that the FCA has been looking at the payments sector very closely, and the closer we look, the worse the picture gets. So that's a message there that they really see there being a problem. Now, the reason for that is, I think, failures, high-profile failures. Wirecard, obviously huge, not directly for the FCA, but it was an e-money institution which had major fraud by the German parent, and the FCA closed down the UK entity for between Thursday night and Monday night, while they went in to check that the UK entity was still okay. Now, one of the things they discovered on that is that a lot of Wirecard cardholders had no idea they were Wirecard cardholders, because Wirecard's business model was to have as distributors lots of other people who had their branding on the cards. And lots of those people, their business model was to provide services to the unbanked as an e-money institution, which meant lots of quite vulnerable people ended up not being able to use their card from Thursday night to Monday night, which caused all sorts of ructions on that. So I think that flagged up to the FCA that this is a slightly more complex area than we might think. Then we had Premier FX, which was a major failure of fairly small business, but customers lost money. And the company involved was basically telling customers that they were protected by Financial Services Compensation Scheme, which they weren't, and was giving a misleading view of it to customers. And then we had Ipagoo. Ipagoo was an e-money institution which was a settlement member of CHAPS and Faster Payments. In order to be a settlement member of CHAPS and Faster Payments, the FCA actually had to give a letter of non-objection to the Bank of England and PRA. So when Ipagoo went bust with money in the wrong place, that was extremely embarrassing to the FCA. And things that get on the front pages with customers losing money, they really don't like. So they've suddenly woken up to their risks in this sector, and we've had a pendulum swing from we don't really need to worry about it to, oh my God, there's problems in this sector, so we need to look at it really hard. So anyone in the sector needs to be aware that they're really right in the FCA sights at the moment.
And that's a number of pretty high-profile failures, basically, of payments and e-money firms over the last few years. What are the lessons that we should be learning from them?
Right, lessons are make sure your safeguarding's being done right and you can prove it. Anyone who's heard me speak, and any of my clients will probably fed up with me saying this, but as far as the FCA are concerned, if it's not written down, it didn't happen. If you haven't got the evidence that you've done things correctly, then, and the FCA come and ask questions, and they may well come and ask questions. Another thing that Nick Webb said at our event was, if you appear on the FCA's radar for anything at all, you're likely to be subject to a holistic review, which is basically a drains up. We'll look at everything. And the first thing they will look at, because it's a major customer protection issue, is safeguarding. If you're not doing safeguarding properly, then you're going to be in a bad situation with the FCA. We've seen a number of situations where the FCA have looked at firms, have seen they're not doing things correctly, and have basically asked them to volunteer to stop doing business until they get things sorted out. And that's the sort of, we'll have two volunteers, you and you. If you don't volunteer to do it, then they'll go through the regulatory actions process, the enforcement process, and you really don't want to be there on that. The other thing is governance. And that kind of ties into the safeguarding thing, in that you need to say why you've made the decisions you have. You really need to have a record of decision making. Your board needs to be there. Your board needs to be on the ball with it, and again be able to prove that you've done it. I mean, part of the problem in the sector is a lot of very small firms, 2, 3, 4 people running firms, and they know what they're doing. You know, they're in money remittance, send money to Brazil, to India, wherever, and they understand their business. But if you've got 2 people and they're working together, of course they discuss things, but they very seldom write it down. They very seldom record a reason for decisions. And going back to what I said about if the FCA taking the view if it's not written down, didn't happen. The governance process, the recording of decisions and the reasons for them is something that's not being done well in this space. The other thing I would say is, if you have a problem, if something's gone wrong, then don't hide it from the FCA. Ideally, you find out something's gone wrong, you sort it, and then you tell the FCA, this has gone wrong, and this is what we've done to sort it and make sure it doesn't happen again. That's the best process. But if something goes wrong and you don't tell them, and it either gets worse or they come to do a holistic review later on and discover that you haven't told them, that would be a breach of Principle 11 of not being transparent with the regulator. And that not only puts the firm in danger, it looks bad on the individual, the payments, the payment services individual or the e-money individual on there who has responsibility. Because one of the things the FCA are really looking at is individual accountability for firms. So let's say those are really the messages on that: is be on top of things, prove you're on top of things, and be open with the regulator, or you could get yourself into quite deep trouble.
And that last point has been one that's been raised several times with other speakers as well, actually. What we've been talking about, Section 166 is, for example, that sort of thing is basically, don't try and hide this, don't try and hide it from yourself, let alone from the regulator. Attack it head on. Yeah,
if you give them a sub 15 Annex 4 notification of it, and I say ideally you can say, this has gone wrong, this is what we've done. It's been sorted. Here's what we've done to avoid it happening again. That's a good place, and you're being open and honest with the regulator. But there's an awful lot of attitudes of, we don't want to tell the regulator that in case we get into trouble, and they say you'll get into much deeper trouble if you've not been clear with them.
Absolutely. Well, we're approaching PSD3 now, the UK government's review of payments legislation. What would you like to see in the new laws, and what do you expect to see?
What do I expect to see? Well, I would like to see a loosening up, actually, of safeguarding legislation in the UK. Part of the problem, and this was actually being seen by the FCA's attempt in the Ipigu case, to argue that there was a statutory trust created over safeguarded funds. Because from the FCA's perspective, if the statutory trust was created, it didn't matter that much where the funds were, as long as you could say these are relevant funds and they're therefore protected by the statutory trust. Unfortunately, they lost that case in the appeal court. It's an interesting court judgment to read if you're an anorak like me, but it does get to this the position where what that means, that court decision means, is if you haven't done safeguarding by the book, by what it says in the regulations, the potential is that in the event of insolvency, the administrator or the creditors of the business will come along, and to be honest, I think they'd be duty bound by their position to say, you haven't done safeguarding correctly, therefore the protections in the payment services regulations or e-money regulations do not apply. So I'm claiming all those customer funds to pay off the creditors. And I think it's something that is odd, because the way the UK has implemented it, and I probably hold my hand up to say I didn't twig this at the time either, but it is if you don't do all those things. So in other words, you can't commingle funds. So if you've got £50,000 of safeguarding obligation and your safeguarding account has £55,000 in it, on that, the administrator can say, well, that £5,000 is the company's funds, therefore they're commingled, therefore the whole you haven't done it properly, so I'm claiming the whole 55,000. But there's an odd thing, because in the regulations it also says any funds that are left over after distribution of funds to payment service users goes back to creditors anyway. So it's not easy saying that you've got to have at least the amount in the safeguarding account, and you could perhaps say not excessive on that, but that would actually simplify things a lot. Would protect the customer and wouldn't actually disadvantage the creditors on that. So that's something I think I would like to see. I would definitely like to see there be more more availability of safeguarding accounts. And the other potential thing, which I did put in our response to the Treasury on it, is that you could actually do with safeguarding and say, no, it's actually covered by FSCS. I think FSCS would hate that because I don't think they want another 1,500 firms coming on, particularly smaller firms, on that. And it would put a lot of onus on the firms to keep proper records and so on that. But it would give the customers more general protection rather than relying on the firms. One of the difficulties with safeguarding is, from the regulator's point of view, is it's entirely under the control of the firm itself. And if you are, I mean, one of the things the FCA were definitely concerned about during COVID, where they thought there may be liquidity issues, was if you're a firm and you're having difficulty paying your rent or your premises or your staff salaries that month, and you've got a big pool of money sitting there that's under your control, the temptation is always going to be there to temporarily borrow from that account just to tide you over that month. And of course, we'll sort it out the next month. But to quote Jack Queen, my first lending manager back in the days of the Clydesdale Bank, there's nothing quite so permanent as a temporary overdraft. And that sort of thing would be liable to roll on. So I think it's, that sort of thing might address it. I think one of the disappointments in PSD3 actually is that they have removed in the Commission's in the proposals that came from the EBA, the Commission have adopted it in the proposal they put forward, is they've done away with the card-based payment instrument issuer concept. Now, it's one that's not been used much, but it has been used in the UK, and it's been used successfully in the UK. And actually, a client of mine, a UK company, would like to move into Europe. And so we've been arguing with the Commission that actually there's a model where this would work and you should take it out. Interesting thing as well is the model is basically we're going at EU level into a directive, which is basically for authorization, and a regulation for all the conduct of business stuff on it, with the EBA as the deciding entity on what's on the interpretation of that. So I think that's going to be very interesting to see how that works out. One of the surprising things to me in PSD3 is how little the prudential requirements have been increased. I think it's going to be, I was expecting them to go up considerably because they hadn't actually changed since 2015 when the directive was first agreed. So I mean, actually 2007 when the first directive was agreed. So 16 years, and they've not gone up that much in terms of the Commission's proposals on that. The merging of e-money directive and payment services directive, which is something the Treasury are looking at as well, is an interesting point of analysis and discussion as to what constitutes e-money on that. If it's just a payment institution with an e-money permission on it, how does that work? When does it stop being e-money? When does it become a payment account? It really gets into that. And that also impinges in the cryptocurrency space and stablecoin. If you've got a stablecoin which is tied to a fiat currency on that, so it's effectively set out in fiat currency terms, that looks an awful lot like e-money. So actually getting that and getting the authorizations is going to be quite interesting.
You mentioned that you'd like to see some loosening of some of the regulations. Is there any concern about divergence from European requirements in that respect?
I think there is. I think not so much in the safeguarding space, which is one of the main areas that I said, because safeguarding is done differently in different countries. Anyway, for example, in the Netherlands, there's a trust set up, and so on. The funds are actually held kind of separately and centrally on it. So I think it wouldn't be that much of an issue to move that to diverge that much. I think it's much more in the conduct space and in the rights and obligations of parties on it where it would work on that. And of course, the thing is that when we're doing transfers in euro, because we're signed up to SEPA, then essentially we are still, for that, we've still got to abide by the SEPA rules on that. So the actual making of euro payments through the SEPA schemes will still be subject to the EBA and the commissions and the directives and so on that. And I know, having worked on the SEPA direct debit scheme rules, how complex that is on that side. But no, it's going to be interesting to see. I mean, I think you see one of the other things that's coming up and will be really interesting is whether, if we get in the legislation something that facilitates virtual recurring payments or variable recurring payments, I always get that that mixed up, to what extent that becomes competition for direct debits. Because VRPs are much more flexible, and I think with the cost of living crisis we have for people, for vulnerable customers, it would be advantageous to be able to, say, attempt to make a payment and not just, okay, we've missed it this month on it, therefore here's a £20 fee, customer, for us not being able to pay your direct debit, but something it just makes an attempt to get a payment. So it adds flexibility to the customer. Now, obviously, it's not as advantageous to the say the utility company, because one of the advantages to direct debits to utility companies is they know exactly when they're going to get the money and what money they're going to get on that. So it eases things. But I think that will be an interesting push to see to what extent that comes through and to what extent is that facilitated by the regulations when the Treasury come through with it.
And what would you say are the biggest challenges for payments firms at the moment, both existing firms and new entrants?
I think the biggest challenges are getting governance right. And consumer duty coming as well is one of the things that is there, and the FCA expecting new firms to have their consumer duty arrangements in place. I am non-executive director of two payments firms at the moment, and guess who's consumer duty champion on both those boards? It's is the FCA's expectations of firms have risen. Governance is becoming ever more important, and actually being able to prove that. Say one of the requirements is to have people with appropriate knowledge and experience in the management on board of payment services firms. And it's the FCA are really looking hard at it. In the past, you might have got away with someone leaving and not being replaced on that, and the FCA might not have picked it up. These days, they're quite likely to look at it. And for new entrants coming in, the FCA are now interviewing PSD individuals and EMD individuals. And they're really cracking down on it. They really expect people to know. I say, coming from a consultancy background, we know that we will provide policies and procedures and so on, template policy and procedures, but we will tailor to the firm's business model and so on. But too many people and new entrants are just saying, oh, yes, you do that for us and that'll be fine. No, it won't, because the FCA will ask you questions about it. They want to know how you're doing these things, how these things are happening. I think, say, one of the things which I often find firms don't get is they don't just want a policy statement that say this will happen. They want to know how it will happen. You see that in wind down plans. You also see it in safeguarding. One of the things I often see in doing safeguarding audits is there's a policy statement that says, oh, in the event of there being a shortfall in safeguarding, we'll fund it from our own resources. Fine. Who can authorize that? What's the escalation process? How does that happen? It's very seldom there, but that's the sort of thing the FCA are looking at. They don't just want to know what, they want to know how. And firms actually getting that handle on that is a really important thing. And it's a change in attitude. The 180-degree change, the pendulum swing of the FCA's attitude is, I think, not quite got through to firms at the moment what this means. And getting ready for that is really where they need to be.
Yeah, that makes a lot of sense. The devil's in the detail if you don't understand the detail.
Exactly.
Yeah, I completely get that.
They expect the management to understand the detail.
Yeah, absolutely. Yeah. So finally, what advice would you give to management of payments firms to keep them on the right side of the regulator?
I would say expect the FCA to come and ask you questions on anything at any time. If you work on the basis that the FCA might come and ask you, and as I say, this holistic review threat is there on it. If you work on the basis that that's there and you're ready to go, so if the FCA come and ask a question, you've got the answer there. You've done a safeguarding audit. You can say, if they ask you about safeguarding, here's the audit we had done. Here's what the finding was. Here's what we've done to correct that. Here's our wind down plan. Here's the review of it. Here's our board minutes that says we're looking at safeguarding on an ongoing basis. You need to assume that the FCA are looking around at you, and they might pick on you at any time and start asking the questions. You might get section 166. You might just get them asking questions before that. If they find something that is wrong, then they're quite liable to stop you doing payments until you get to a stage and then have a section 166 at the end of that. If you're able to give the answers quickly and show you've been prepared, you've actually been understanding and actively managing these things, you'll be in a much better position to keep the FCA happy.
So always expect the worst, be prepared for the worst, and hope for the best.
Exactly that.
Yeah. Okay. Thanks, John. That was really, really good insight there.
Thanks, Rob. That was good to speak. I hope it was useful for those watching and listening. Goodbye.
That's about all we've got time for today. So please join us for the next episode of Compliance Matters, when we'll be having John coming back to talk to us again. This is Middlesex Partnership Compliance Matters. I'm Robert Johnson. Look forward to seeing you again. Thanks. Bye.